You hear about the stock market everywhere, but what actually is the stock market? And more importantly, how do you invest in it? We'll cover that in this video, but as always, this is education and not meant as financial advice. We know a market is a place for buying and selling goods, and a stock is a piece of a company. If we add up all of the places in a country where you can buy and sell stocks, you get the stock market for that country. You might be able to see now why the term investing in the stock market doesn't quite make sense. What people generally mean is that they're going to invest in the stocks. But why would companies want to sell pieces of themselves? Well, it's a way for them to raise money to further grow the company without having to borrow and pay interest. We as investors would want to buy them because the stocks could increase in value and be sold for a profit later on, or they could entitle us to a share of the profits of the company, known as dividends. The question is, how do you decide which stocks to invest in? The first step is to like and subscribe. Then there are two main ways of buying stocks. You either buy them directly from the company during their initial public offering or IPO, or you can buy them from other people, known as the secondary market. The vast majority of trades are done on the secondary market. There are thousands of stocks available for you to pick, but a shocking statistic is that 90% of the time people are picking stocks, they fail to beat the market. Now, what do I mean by beat the market? When a large range of stocks increase in value, people generally say the market is doing well. In the United States, this commonly means the S&P 500, which is a list of 500 companies in the United States weighted by their market cap. A more fancy term for this kind of list is an index. But it seems a lot of work to buy a proportional piece of these 500 companies though. Surely there must be an easier way. Very conveniently for us as average investors, there are funds that aim to copy these 500 companies and their proportional values, known as index funds, specifically in this case, S&P 500 index funds. So when you buy the fund, you are buying a small piece of the top 500 companies in the United States. Even better, if one of these companies goes bankrupt, then it gets replaced by another company, so you don't suffer the full collapse of the company and the list is continuously updated. Another major benefit of these index funds is that the fees are extremely low. They are passive and don't need management. So if these are so good, why do people try to pick stocks? Some people are able to consistently pick stocks that outperform the market average and therefore get a higher return, especially if they invest in smaller companies with large growth potential that are not yet available in indexes. Also, since the index is representative of the market, if there is a general crash, the value of your stocks will go down. However, choosing companies that you think would do well in a crash would let you reduce your risk. Many online brokers exist to allow buying and selling of stocks, ranging from just wanting to invest and forget, all the way to the advanced day traders. Leave a like and subscribe to help us make more finance and self-improvement videos.